In this chapter, we're going to talk about the corporation. In general, what we're going to talk about are just some fundamental concepts about business and how finance interweaves and relates to the overall concept of running a business. So in this particular chapter, we're going to cover several learning objectives. We're going to talk about the types of businesses. We're going to talk about some concept of liability, some taxation issues. We'll talk a little bit about ownership and some of the impacts that the ownership of stock has on making corporate decisions. We'll talk about the concept of agency, and we'll introduce some basics of the stock market. So first of all, what is finance, right? I mean, essentially it's really going to answer or address two questions. What long-term investment should the company choose? We'll develop a model of how to establish the value of assets. And then, how should the firm raise funds for those selected investments? So how this is going to break down in the course is we're going to ask, again, questions. How do you determine the value of an asset? How do managers choose among sets of assets? How do managers gain access to funds? How do they decide what type of source of funding to use? And we're also going to address some metrics in how we assess firm performance. So if you kind of think about the world, the business world, finance tries to answer certain questions. The first thing it looks at and talks about risk and return. Are all the risks in the world the same? Or do they have different impacts on business? How do we assess the value of money that occurs in different time periods? Which is more important, profit or cash? How do taxes affect this decision? How does our accounting methodology affect this decision or this concept? What is the definition of a competitive market? Do we have competitive markets? What do owners really want from a company? Right? What is the true financial goal of management? In other words, what should they be thinking of when they're making decisions, essentially making decisions on behalf of the owners of the company? How are prices determined? There's a concept referred to as efficient markets. We'll describe how we think information influences stock prices. How do managers think and make decisions? Are there conflicts between managers and owners? Are there conflicts between owners and creditors? What's cash flow? How important is that? Are ethics important? And in the end, how should we measure success? So again, we're going to cover these basic topics throughout the whole course in one context or another. So first question we have is, how do you define business assets? The simplest definition refers to the assets that the business uses to produce revenue and or provide services. But that's not the total answer. A better answer refers to the assets of the owners that are at risk should the company encounter challenges, such as bankruptcy or lawsuits. So with respect to this, we need to understand the concept of liability. Liability refers to the responsibilities should one get sued. Obviously, if you get sued, one of two things can happen. You can either win or you can lose. We're not concerned about winning our lawsuit at this point. We're addressing what happens if you lose the lawsuit, and of course there's a penalty that you have to pay. So what are the business assets of a corporation? In other words, what are the assets that are at risk? In a corporation, the assets that are at risk from the owner's perspective is their stock. So the only thing they can lose is the value of their stock. But as a sole proprietor or a partner, the assets of the company, the business assets that are at risk, have a different definition. In a partnership, all the assets of the owners, including their personal assets, are at risk. So we have two concepts here, or two categories, if you will. Unlimited liability means that all the business assets are at risk should funds be needed to pay on lawsuits, for example. So in a sole proprietorship, unlimited liability means all of the assets, all of the business's particular assets in particular, but also all personal assets are at risk. Limited liability means only invested capital, only the owner's investment in stock, for instance, would be at risk. So as we talk in the next couple of slides about different types of businesses, one of the things we have to be concerned about, if you think about the type of business, we have to be concerned about what risks the owners are taking. What assets are they using or can be used as a definition, if you will, for business assets. So the first kind of business type is a sole proprietorship. This is the greatest number of businesses in number size. You know, it's run by one person. Typically, it has a few, if any, employees. Most employees are typically going to be family members. The basic advantages are they're easy to create. They, in general, have lower taxes to the owners. The disadvantage is there's no separation really between the firm and the owner. So that means personal assets are part of the business. It has unlimited personal liability. So if you get sued, it's possible you could lose your personal assets. Of course, since there's no separation between firm and owner, when the owner dies, the business dies. And finally, it's kind of difficult for sole proprietors to raise money. We have very limited sources available to us. A partnership is very similar, except now we have more than one owner. Now all owners, all partners, are personally responsible for all the firm's debts. They have unlimited liability. Now technically, the partnership ends with the death of a single partner. That's technically true. However, if we had 3 or 4 partners, essentially the partnership would continue, but there would be some accounting changes that would be need to made to keep the business going in the right direction, or in a forward direction. And again, just like with a sole proprietor, it is still rather difficult to raise money in a partnership. Now, there are 2 kinds of partnership. There's a general partnership. This is where all the owners have the same rights and liabilities. They all have unlimited liability. And typically they are involved in the day-to-day business of running of running the business. Limited partners, though, have limited liabilities. They can't lose more than their investment. We actually refer to these kinds of limited partners as silent partners. All they do is contribute cash. And in fact, the IRS has very strict guidelines of a definition of a limited partner. They can have no management authority. In fact, they can't even be involved in any of the decision making of the company. So there's two different types of partnerships. An invention, if you will, that's relatively new in the United States is something called an LLC. Essentially, this is a business arrangement where all owners have limited liability, but they also can run the business, so they can be involved. So you can see it's kind of a hybrid between a general partnership and a limited partnership. Corporations, the largest amount of revenue comes from corporate entities. They're a legal separate entity from its owners, right? They have legal powers, or many of the legal powers of individuals. The corporation is solely responsible for its own obligations. So what this means is that the owners of a corporation have limited liability. You can only lose the stock, the investment in the stock of the company. So when corporations are formed, they have to do this within a state. It's called a charter. And essentially a charter sets up the rules of the company. Turns out that because of the legal environment, Delaware is a popular choice for incorporation. This primarily has to do with the judicial system. That Delaware has a separate judicial branch, if you will, that is entirely geared at business. So obviously if you have some type of a business issue at court, you want a person, a judge, who understands business to be dealing with your case. You really don't want a judge who, last week they were on a murder trial, and this week they're going to be talking about some lawsuit that you have with another business. That's why the incorporation is a little bit different. As far as corporate ownership, obviously it's represented by shares of stock. We talk about shareholders, stockholders, and equity holder. Again, the term equity refers to ownership. So if you add up all the value to the owners, that's what's referred to as equity. And there's really no limit to the number of shareholders a company could have. However, they do state in their corporate charter how many shares of stock they will currently want to issue, if you will. So when a company starts out, they could say, hey, we want to issue 400 million shares. But after they issue all those shares, and down the road, they may want to issue more. So they'd have to revise their corporate charter so that they could issue more shares. And of course, the owner is entitled to dividends. In fact, the owner owns the profits of the company. So we have, we'll discuss about this in a lot of detail, because obviously the payout to shareholders is a very important question with respect to how the company invests its money, how it gives returns to its owners. Those are all very important questions we'll cover throughout the course. There are tax implications, though. We mentioned a little bit earlier that sole proprietors relatively have a lower tax rate than corporations. The reason for this is a concept of something called double taxation. Essentially what we have is the corporation, since it pays its own bills, has its own tax bill. And once earnings are distributed to owners, the owners also have to pay taxes on their income. So the concept of double taxation says that corporations pay taxes twice. There is something referred to as an S corporation, and basically an S corporation says it's not subject to corporate tax. In fact, it is taxed just like a partnership or a sole proprietor is taxed. So instead of the S corporation paying taxes and then its owners paying taxes, essentially it's what's referred to as a pass-through entity. The income passes through the corporation to the owners, and then the owners pay taxes on that. So in the next slide, in the next part, we will discuss some of the calculations, and so we can understand this concept of double taxation a little bit more.